So let's talk about that a little bit. How do you recognize a bubble?
Okay, welcome to Compound Everything, where we talk about marriage, money, and markets. Markets, money, and marriage. Marriage, very little. But we are married. So
we are married.
So it just comes into the conversation.
That's true. So what are we talking about today?
We're going to talk about bubbles today.
Bubbles, okay.
Bubbles,
fun.
yes.
So what kind of bubbles are we talking
It
about?
is super fun. Financial bubbles.
Financial bubbles, nice.
Yes. Well, a financial bubble is just when an asset class inflates in price.
Yeah.
For no other, well, sometimes it's for good reason, but mostly it's just the reason behind it is kind of like because it's going up, it must be a good investment. Therefore, more people will put their money in, and the bubble gets bigger and bigger until someone realizes this is an unsustainable price for the whatever the asset class is.
Something pops it.
Right, and they start pulling money out, and then of course selling begets more selling, and the bubble bursts.
Right.
And the burst is usually catastrophic for people, and it happens.
So often there's a fairly rapid price escalation, but followed by a very rapid price decline.
Yes.
Call it. So
and there's
that's
been bubbles
a bubble.
In many different asset classes.
Asset classes, sectors, and whatnot. Right. So we're talking about bubbles. So what got us thinking about bubbles was a movie we watched recently. It was starring Michael Douglas, one called Wall Street.
Yeah,
Forms.
I had nothing else to watch.
Had nothing else to watch. We were bored and then go, oh, Wall Street. Never saw that one. In that movie, Michael Douglas, who's one of the main characters, had a picture of a tulip bulb and had the tulip bulb chart on there of the price escalation of the tulip bulbs. Right. And so we got interested and started looking into tulip bulbs.
Yes, and we were very familiar. We hadn't really looked into it, so that kind of put
spurred our
us,
interest.
just because of the way the chart looked, we're like, oh, like what drove that? So we, in our assumption, without looking into anything, always thought that the tulip bulb mania, the real manic part of it, was kind of like working class people just trying to get into, I guess what people would call retail money now, or dumb money now, trying to get into the profits of the tulip bulbs, and we assumed that retail was just driving up the mania and then it burst. Right. But after looking into it, you found at first that what really drove the mania were the financial experts who created derivatives based around the bulbs, and that is when the real craziness.
That's when the craziness started to happen. Is when the derivatives started coming out. So
there's actually a quote. I have a quote, and it says, "Part of the genius of financial markets is when there is a real demand for a method to enhance speculative opportunities. The market will surely provide it. The instruments that enabled tulip speculators to get the most action for their money were call options, similar of those bought in today's market." Right. So they will supply, the financial engineers will supply the demand for what the people want.
Now, what's that? I'm going to briefly paraphrase Warren Buffett, who calls derivatives weapons of mass destruction. And so
and in this case,
we'll kind of go into why that is, well, maybe not into his quote necessarily, but you'll see from the example of the tulip bulb, we'll describe that, maybe why that's the case. Right. So why don't we describe what happened?
Okay, so in 1593, someone brought the tulip bulb over to the Dutch people. Yep. So it was rare, it was new, it was exciting, it was pretty.
It's a pretty flower.
Everyone wanted to have tulips.
Right.
It was the thing. And so people bought it, and a market was
So they started to catch on.
Yeah, a market was created for the tulip bulb because they weren't native to that area. Yep. So there was a definite market, right? Like there's markets for everything. There's fish markets, there's all markets, right? Right. So about 10 years later, the tulip bulbs started to develop a disease called the mosaic. Yes. You have the rare tulip, and now you have the even more rare disease tulip. Right. As it gained popularity, more and more people were making money on it. Right. And as people saw people making money, more people got into the market. And that's kind of exactly, that is the bubble cycle. Right. That is the snowball of the bubble.
Well, and we were talking about this earlier, that you could kind of see this happening even today. So we were talking just a few minutes ago about the GME bubble.
Yeah.
So these things still happen. So there's lessons to be learned from the tulip mania. So what really, in my estimation, what was really fascinating about the tulip mania was that people were paying just astronomical prices in the end for these tulip bulbs, or at least claims for tulip bulbs.
Yeah.
And one quote I found said, the highest price for which there's good evidence that a tulip bulb fetched was 5,200 guilders in 1637. So I have no idea what a guilder is. I don't know how much that equates to necessarily, but it says this was approximately 20 times the annual salary of a skilled worker such as a carpenter.
Really?
Yeah. And some of the, I've seen in other places where they are saying that, one of the most prized tulip bulbs, one of the most prized bulbs there, would have fetched somewhere around $1 million.
Okay.
For this tulip bulb.
So I do know, actually the first tulip bulb actually got stolen and was sold. A thief stole it.
Yeah, I heard about that.
Yeah, and then he actually did make a profit, but not as much as a profit had the original owner of the tulip bulb.
Right.
Yeah, and then there was another story of someone, now this makes more sense, who there was a tulip bulb, and I'm not sure if he was going to be given it, or I'm not exactly sure, but he cut it thinking it was like an onion or something.
Oh, okay, yeah, I read about that.
And then I think I don't know if he went to he was punished anyways.
Okay,
so
what?
I have no idea, but things are getting wild.
Yeah, things are getting wild.
So and everyone by the 1634, everyone was jumping in. So we're talking like people, farmers to noblemen, and people were selling their furniture, they were selling their house, they were
property,
selling
even
their family wealth to get their hands on a tulip bubble. Tulip bulb.
Yeah. So, but apparently, part of what makes the bulbs so valuable at the time was that you can either get seeds from the tulips or you can get bulbs from the tulips, right? And tulip seeds take a long time in order to generate the plant, something like 7 years or something like that.
Oh, okay.
I didn't know that. Whereas the bulb will sprout in a year to 3 years.
Yeah,
and so the tulip bulbs had that characteristic to them, that they were kind of quick turnaround. Also, they could be split off, I guess, too. So not too different from having like a thoroughbred horse that you can kind of breed. So if you had this bulb, you can get other bulbs in there. So this is my understanding. It could be corrected if I'm wrong, but that was my understanding as to why these bulbs were partly garnering so much value. So people thought that these were a store of, I don't know if people thought they were a store of wealth or something, but they thought they could profit off of the fact that these bulbs could be split and generate other bulbs.
No, I guess. So there is
there may be some skill to that.
There is a little skill to that, right? But the thing is that what happened by the 1630s, by the mid to late 1630s, was that people were putting their money into tulip bulbs and thinking, like speculating, that they were a good investment simply because the tulip bulbs were going up in price.
Right.
So the tulip bulbs, as the tulip bulbs were going up in price, so maybe at the beginning, like way back, right, in 1594, there was a market created, and whenever there's a market for something, there's always an opportunity for arbitrage.
Yes.
Right?
For sure.
And so there might have been a small market with modest profits if you knew what you were doing.
Right.
But as people saw other people getting wealthy and other people making money, they wanted to get in.
There's a fear of missing out.
There was a fear of missing out. And so what was happening was the core idea in 1634 to 37 was, because the tulip bulb keeps going up in price, it is a good investment and will keep going up in price. Right.
And therefore that justifies a higher price paid.
Which is
lunacy.
But if you think of bubbles, that is every bubble. This is a good investment because it is going up in price.
Right.
Therefore, it will keep going up
in price.
And I don't know if it was Buffett or Munger who said the stupidest reason to buy a stock is because it's going up in price.
Right. I can't remember. There's one of those two guys.
Yeah. It's probably because they've studied financial bubbles.
Right.
People buying tulips in the mania, they were assuming a greater fool would come in and buy it from them.
Until they don't.
And
here's a quote I found. It said, "Financial bubbles burst when expectations reach a tipping point. Once enough people expect prices to fall, the supply of greater fools dries up."
Right.
So
exactly.
That's it. So
there's only so many greater fools.
So the price keeps going up until it doesn't. Right. And then at that point, you'll probably see the market collapse.
And in a bubble, the collapse is fast and
often
furious,
fast and furious.
And a lot of people get burned.
Yeah.
So anyways, as this bubble was going crazy, of course, financial professionals come in, and there is always money to be made on people's lack of self-control in the market. So go ahead and introduce the derivatives in the tulip. And this is what really... It was the derivatives that really caused a lot of financial harm to people. Yeah. It wasn't just the buying of a bulb, although if you sold your wealth and it went to zero, that still hurts, but it was the derivatives that really, really hurt people.
So what ended up happening, it might have not have gotten so crazy if it was just people buying and selling in a simple transaction. So you have a bulb, I have cash, I want your bulb, I give you my cash, there you go, transaction
you'd still
complete.
be hurt if that bulb went to nothing because you're out the cash.
I gave you my farmland to buy this bulb, now I have a bulb in my hand, you've got my land, which, you know, is obviously continuously productive. Now I've got this bulb, which, who knows, it might die. You know, we don't know.
It's just wild.
But anyway, the point being is, if it was a simple transaction such as that, maybe not as many people would have gotten hurt through it. So what ended up happening was it went beyond that. So people were selling essentially options against claims for tulip bulbs. So if you maybe had some tulip bulbs, you would maybe sell me the right to purchase a tulip bulb, and then I would go sell that right to someone else, and they would pay me more for that right than I bought it for. So then they could sell that right to someone else, and this big, it sounds like this big pyramid ended up happening around all these kind of derivatives. So essentially these were call options against bulbs, against tulip bulbs. So you might not have, like I might not even have had a tulip bulb, but I was selling the right to purchase a tulip bulb. And the point being is at the end of the day, there might have been people selling these calls against against tulip bulbs they didn't have, and other people were buying these things at inflated prices. And I think what ended up happening in the end of it was...
But if you bought from me, I had to produce.
Then you had to produce.
Yeah, that's what I'm saying. Like someone had to produce
these bulbs.
Bulb.
Yeah. And so in the end, I think what ended up happening, and I'm not quite sure I totally understand the history here, is the people were starting to default on...
Yeah, so that's what happened. People just didn't produce. So if I sold you a contract to give you my bulbs, in the crash, they were literally just walking away. I was like, yeah, no, don't have it. Right.
And then people were not able to produce them, or people were not paying for them. Either. So at the end of toward the end of, I think it was 1637-ish, the Dutch government came out and said that there had to be a minimum price that you had to pay for these claims. I can't remember, it was 5 or 10% or something like
10.
that.
I think it was 10. But
10%? So there was a percentage that had to be paid, but then at that point, when stuff like that started happening, the whole thing started to collapse. And so
they went lower even than, like, the government didn't think it would go as low as they had put the bar, whatever it was, 5 or 10%. And then they just went down to that.
And then the whole thing cratered. Now there's some speculation as to why it cratered in part. And maybe that was kind of the pin that pricked the bubble. Or there was I have another quote here. It says, having seen abundant shoots in their journeys, bulb traders might have realized that a crop would have been bountiful and rare flowers rather less rare than they had imagined. And thus basically supply increased. So I guess there may have been an increased supply of tulip bulbs, and all of a sudden now people don't have to pay as much. And so supply and demand kicked in. There's more supply, therefore satisfying demand, therefore the price goes down, and then the whole pile of cards comes tumbling down.
And then you add the derivatives in and everything.
And everything. And that's probably the derivatives, in my opinion, are probably what ended up inflating the price so badly.
And that is the same as that. There's been there's a couple of people who agree with that. Like when I've looked into it, it's more than one source that say it was the derivatives that really pushed the price up so high.
Well, think of that.
That was the thing. What the derivatives did was just made the bubble all that much bigger. So whatever caused the collapse caused it, but the derivatives are what got the price to be so astronomical. That's the first kind of bubble. That is the bubble that so many people reference. So there's the South Sea Bubble. The South Sea Bubble. That one is interesting because
I think you know more about that.
I don't actually know a lot because I'm going to confess it wasn't as interesting to me.
This was super interesting.
Because tulip bulb is just so...
Like who gives away farmland and homes for tulip bulbs?
Like, you know, I mean, like you come home one day and you're like, oh, babe, I sold the house. And I'm like, oh, and like...
It's like getting magic beans.
It's just so intriguing to me that it did that. Right? But so the thing about the South Sea Bubble, my main takeaway, I think I had 3, is that fundamentals eventually matter.
Oh, for sure.
Because they didn't have any fundamentals.
Right. Okay, yeah, you mentioned that. They had a lovely office and all that stuff.
Yeah, they had like this office, like apparently from what I read, they had like their office had like nice chairs and they looked like this great company, but they really had no fundamentals.
Okay.
Fundamentals.
They weren't making any money.
They weren't there. There was large government involvement.
With the South Seas Company.
With the South Seas Company, okay? And then the office was, so that my point that is that it had like a facade. The management had this great look to them. It was this great company, and they put on this facade for the investors. And so I didn't do a lot of research, but those were the kind of the three things that I picked up. Took home for that. So the South Sea Bubble got really big, and was it Newton who lost money?
Isaac Newton, yep.
Right, so like a lot of smart people got in, and he knew not to,
but he couldn't
resist.
Yeah. And he's probably one of the smartest men to ever live.
Right.
And he got caught up in it.
So, what I learned about that one is the intelligence isn't as important as the emotional, cognitive ability of an investor. And what I also noticed is that there is no level of greed. There's no stop to it, right? No. And it's very hard when you watch other people make money
and you're not,
to not want to get into that asset class.
And that's partly what creates bubbles.
Yeah.
So another bubble that I came across that I didn't know about, but you did, was the railroad bubble.
Yes.
I did just a brief amount of reading, just to know it exists, but I had no idea that was a thing. Mm-hmm. The railroads were a bubble at one point.
Yeah.
So from my understanding, it just involved the railroads as being a new technology, and people just bid up the railroad companies to prices beyond that, which were
beyond their fundamentals.
Right, close to reasonable. It was a new technology at the time. This was in the 1800s. It was new technology. It was supposed to be groundbreaking, and it's supposed to change the world, right? And it was very much so. But the price of the stocks just got completely dislocated from any expectation of earnings. Right? That was my understanding of it, and I'll have to read more about it. Now, I think you know more about that than I do, so I had no idea it was
there's not much to talk about there, because it's the same thing. But the thing about the South Sea is that there was no fundamentals at all going into it, ever.
Okay,
with the rail, it really was a real companies. It was a real innovation. It really did.
It did have promise.
It really did change the world.
No
rail
question.
Really did, right?
And they're still going.
But the problem is, and that's one of those examples of when investors get caught up in
hopium.
Yeah, because like the new tech is there, and you know it's big, and you know it's great.
Yeah.
But the multiple or the price that you put on it, it's just way up on your hopes for it are too high.
Yeah.
It's just not a realistic expectation for where that stock is going to go in that amount of time.
For sure.
Right. So, and you see that all the time. So in the 60s, there was the Tronics Bubble.
Okay, I didn't know about that one either.
Which is very similar to the .com bubble.
Right, that one I know about.
So you can just, I won't spend much time, but I didn't know about the Tronics Bubble.
No, nor did I.
No one really talks about it, but apparently it's kind of like the .com. It was new technology, and companies were just adding like Tronics or electronics to the name, and just by doing that, by simply changing their name to have that word Tronics in it, that would command that stock to a higher multiple.
That's insane. And
it was the same idea. It's going to change the world. It's innovation.
Right.
It can't be stopped. Things were just.
Well, and that's the same thing as the .com bubble, right? So if in the 2000s, 99, maybe late 90s, early 2000s, if you put .com after a company name, that company was bid up like crazy.
Yeah, those two bubbles were very similar.
And that's interesting.
Yeah, so.
And again, it started as well because the internet, people knew was going to be big. People knew the internet was going to be big, and it was turning into something bigger and bigger. It's the problem though was that people were just reading too much into these individual companies.
Yeah, and it was
and bidding them all up.
And again, it got to a point where it was like you couldn't. You were an idiot if you weren't investing in tech in '99.
Right.
Like you were just a fool, and it was the same
idea.
You
looked like a fool.
You looked like a fool. Yeah, you weren't. Yeah, but it was the same idea as a tulip bulb. The price of this company is going up, therefore the price of this company will continue to go up.
Right.
But it just went crazy, and back to the South Sea, a lot of these companies had no fundamentals.
Right.
Right, and it was on what you said earlier.
Some of these .com companies were, some of these .com companies at the height of the .com bubble were worth hundreds of millions of dollars, but had no earnings, and I'm not even sure some of them had offices.
Yeah, they were just. It was crazy.
Like it just got crazy. So there was a promise there of something big, but the the fundamentals weren't there.
Right. Here's Lytton Industries. So this is the Tronics Bubble.
Okay.
Which is similar. So it was the high price was $120. Okay.
When was that?
In 1967.
1967.
Okay, in the Tronics Bubble.
Okay.
And in 1989, the low price was $55.
Okay.
So that's not quite as crazy.
That's not so bad.
Yeah, that's not quite
I mean,
as crazy.
it's not great. I mean, you've lost, 70%.
But the
of your money or
multiple
so.
went down from 44, the PE multiple, went down from 44 to 14.
Oh, wow.
Yeah.
Okay.
Okay.
Well, and the funny thing about PE multiples is oftentimes people will bid up the multiples on the promise that this company's supposed to keep making more money, right? Yeah. And as soon as that growth promise starts to get deflated a little bit, that price goes way
down. Lucent was $74 in 2000.
$74, okay.
Yeah, and in 2001 to 2002, its low was $1.36.
Okay, that's painful.
And that's a drawdown of 98.3%.
That's awful. Okay.
So Amazon, $75 was its high in 2000, and in 01-02 it was $5.51.
Wow.
Yeah, and here's Nortel. I found it. So Nortel was $143 at its high in 2000.
Yeah, Nortel, yeah.
And in 2001, 2002, it was 76 cents.
Wow. That's brutal.
So the thing about bubbles, that when I talk about Amazon, that's another thing I noticed is that Amazon is obviously still around today.
Very much so.
It's gone.
And that's a deal right now. And if you had bought it at 70 somewhat dollars.
Yeah. So oftentimes the speculation, same with the rail, oftentimes the speculation is too fast.
Right.
Like they are right. Like the investors are right. Like the innovation sometimes. The innovation is there. Yeah. And the innovation is going to change the world. Yeah. But for some reason they think it's going to be like tomorrow.
Right.
Right. Or maybe a year. But sometimes it could be a decade.
Yes.
Or it could be two decades.
Right. So how do we identify bubbles? The first way, it says there is some truth or plausibility to the claim. So there has to be some truth or plausibility to the claim that's being claimed. So something.
That's what I was saying about the innovation.
Right.
It's true.
It's
there.
True. Yeah. So with the railroads, they were a real innovation. With the dot-com bubble, the internet was a real thing. It was going to change the way.
And we all knew it was going to change.
And people all knew that. Yeah. People all knew it was going to be big. So the dot-com bubble is a perfect example of that. Secondly, there must be some obfuscation of products involved. There's derivatives that are created, right? So there has to be some obfuscation of what actually is going on in a sense. Not always, but sometimes. So derivatives get involved, and so we talked about GME a little bit on this episode. And there was all these, kind of synthetic shares and all sorts of weird financial shenanigans that were going on. And that's partly what created that bubble. Okay. You could also talk about the housing bubble as well, and how there was kind of odd things going on around there too. Third thing, there is an attempt to skirt regulation. So there's an attempt to skirt regulation.
So what does it make you think of?
SPACs.
Yeah, me too.
So SPACs are a way to get around. SPACs are special purpose acquisition companies, for those of you who don't know. So those have really come into vogue over the past year or two. There's a lot of companies that went public via SPAC over the past year or two. And those were created in order to try and get around some of the rules of the SEC. Yeah.
And actually, a broad market bubble is often identified by a sheer increase of IPOs. Yeah. Like if you actually look back where there's broad market bubbles, not necessarily just like a sector. Right. You'll notice like a drastic increase of IPOs.
Interesting. Okay, I didn't know that.
Well, because it makes sense because when if I had a company I want to take public because I'm cashing out, I'd want to put in a hot market.
Oh, for sure, no question.
Right? Yeah.
Yeah, it's like selling your house or something like that. You want to sell in a hot market, right? You don't want to wait till things are depressed. Yeah. And then fourthly, this is the last one, there's increasing use of leverage to purchase the asset. So people taking out margin to purchase stocks because, stocks always go up. People taking out huge amounts of leverage to buy a house or a second house or a third house.
They're selling their wealth. They're selling their true tangible wealth for this investment.
For this asset, we'll use the term loosely. Yeah. So that was the other thing, increasing use of financial leverage. So again, I think margin.
Which makes the bubble even more catastrophic when it pops.
Exactly.
Which is so sad.
Because the asset may not have increased in value, but your liabilities will certainly remain. Yeah. So those are four kind of areas where if you kind of see these things happen, you kind of go, I wonder if this is a bubble or not.
Yeah, and I think Peter Lynch too, and maybe we can stop with this, said something around the lines of, you know that you're in a bubble when, I think it's like your neighbor, it's not just that your neighbor is talking about investing in stocks, it's that he's investing in stocks and he happens to be right.
Yeah.
That made me laugh. You just want to avoid getting in a bubble.
Yes. Yeah.
Like you really like that. And I feel sad, like 2020, it's sad to watch because a lot of people got in and thought they were geniuses because they were making a lot of money for a time. And now it sucks because they lost all of that.
Right.
And so, what do they say? Don't confuse brains with a bull market.
Don't confuse brains with a bull market.
So, and that's hard to do. Like
that is very hard to do. It's hard to watch people around you make tons of money while you sit on your hands on the sidelines.
Yeah, and it's a little easier together because we can
we coach each other.
Right. So why would you do that? That's stupid.
Right.
Or when you're like, oh, I should have invested in.
So that's a good point. Find someone that you trust and have dialogue with them.
Mm-hmm. Find someone you trust who's comfortable enough with you to tell you that you're an idiot.
To tell you you're wrong.
No, don't do that.
Don't do that deal. Yeah. Don't do that deal.
So.
Anyway, I think that was a good discussion.
Yeah, I think so too.
See you next time.
Yeah.